Okay, so the second main factor that affects cap rates in commercial real estate is capital markets. So really what we're saying is how much money is there out there, and the cost of money as well plays an important factor. So mostly what we're talking about when we're talking about capital markets is interest rates. Interest rates determine lending and the cost of capital in order to finance commercial properties. Remember, most commercial properties do have some loans or debt on them. And so interest rates actually play a huge factor in what cap rates will be. I think the best way to illustrate this is with an example. So let's suppose an investor buys a building that makes $50,000 a year. So NOI of $50,000 per year. And he pays $1 million for it. So using our formula, we can see that's a 5% cap rate, 5 cap for short, as many say in the industry. In this example, he's going to finance 100% of it. I know that 100% financing isn't realistic, but I just want to use it for illustrative purposes. And we're going to say it's a 3% interest rate. So finances 100%, so he finances $1 million at a 3% interest rate. At the end of the year, his interest payment total is $30,000. Okay, $30,000 he pays in interest. How much did that building make him net? So I'm not talking about NOI. NOI we know is $50,000. He paid $30,000 in interest payments. He makes $20,000, what's called net income. So not to be confused with net operating income. Net income is after mortgage payments. So makes his $20,000 per year net. Let's say a year later, he wants to go and sell his property. Now, he's not a greedy investor. He just says, hey, I just want to get what I paid for it, the $1 million, and I want to move on. The difference is now interest rates are at 6.5%. So the property still makes the same $50,000. However, someone who wants to get 100% financing, again, I'm trying to make this example as simple as possible, at 6.5%, their interest payment at $1 million is going to be $65,000. Now remember, this property only makes $50,000. So if they have an interest payment of $65,000 per year, they're actually going to be $15,000 in the hole. So what's going to happen? No one's going to offer $1 million. They're going to offer a number that actually makes sense, that first of all, it's cash flowing, positive, actually making some money. So let's suppose that instead of a 6.5, with a 6.5% interest rate, an investor wants to buy it at a 7% cap rate. So if we do the math, at $50,000 at a 7% cap rate, so we'll do $50,000 divided by 0.07, that would equal around $714,000 purchase price. Okay, so if you're following along, that would actually make the property make a little bit of money if he got it at $714,000. So the original owner, he's trying to sell it. He wants $1 million for it, but all he's getting are these offers for $700,000. Maybe one 680, another one 650, and he thinks they're all lowball offers. But what he may fail to understand is that the lending environment has changed, where interest rates are now higher, and people can't make the math work at $1 million. So while he might see a lowball, the others are actually seeing that, hey, offers are very generous. They're actually not going to make a ton of cash flow off it. So important to think about how interest rates actually affect cap rates. Average cap rates will always float above interest rates. And I say always with a caveat that the market isn't elastic, super elastic like that. So we will get into that in a little bit. But typically if rates are 4%, all properties will float 0.5% to 6% above that. Why the big spread? It's the real estate factors we talked about previously. So let's say interest rates are at 4%. The nicest property in the best area might be a 4.5% cap rate. The worst property in the worst area, worst condition, maybe at 10.5%. So again, I'm making this is kind of a perfect world scenario, but every other property will exist between 4.5 and 10.5%, depending on their area and condition. If the interest rates move up to 5.5%, now the lowest cap rate, the best property may be 7%, and another 6% on top of that for the worst property in the worst area, in the worst condition. So you can see it kind of floats with interest rates. It's important to understand that the math has to work out typically, but it's not always the case. So I want to go over a couple of theories that don't necessarily turn out in practice. So the first one is no one should ever buy into a cap rate equal or lower to interest rates. So if we have an interest rate at 5%, no one should ever buy into a cap rate at 5% or 4% or 3% or anything lower than that. That is simply not true. The NOI can actually be increased, which would be attractive to an investor who thinks that rents are low. So for example, we used the $1 million property producing $50,000. If interest rates were at 6.5%, the interest rates would equal the interest payments would equal $65,000. So you'd be $15,000 in the hole. However, if you thought that the NOI was low because of low rents, you could actually increase that to $80,000. You would then be plus $15,000 cash flow positive. So a lot of investors will actually purchase properties thinking that rents are low and that they can increase rents to make it actually worth it. The second reason is that we use the assumption that you'd be financing 100% of the property. If you're putting a down payment down, so typically 25%, you can put down for a multifamily. That decreases the amount of your loan, which means you're not paying interest on 25% of the property purchase. So the more money you put down on a property, the less interest payments you have, obviously. And then therefore your actual payments, your monthly payments are less. It means you're going to be cash flowing more. Right up until you pay all cash and have no loan, then interest rate is really completely irrelevant. So that's why you might not see, you may see actually people buying below, cap rates below what the actual interest rates are. The second theory I want to get into is market cap rates should immediately go up, meaning prices drop, as soon as interest rates rise. Simply not as elastic as that. So if, say on a Monday, a property is worth a 6% cap and interest rates are at 5%, on Wednesday, the Federal Reserve announces that they're going to increase interest rates to 5.5%, you'd expect that cap rates would, especially of that building, would go from 6% to 6.5% to kind of match the jump of interest rates. Very simplistic example here. That will happen, but it won't be immediately. If you can imagine putting yourself in the shoes of a seller, sellers can be emotional. If they're not forced to sell, imagine their property is worth a 6 cap on a Monday, interest rates go up on Wednesday. Come Friday, they're being told that the value of their property is now a 6.5 cap. That is not going to ring well with them. It might take some time for them to actually accept that number, even though they're getting lower offers that are more in line with 6.5 cap. So that really goes to show that there is a theory behind it, but how it turns out in reality is not always exactly that way. But typically, supply and demand forces will work together to bring average cap rates above where interest rates are at. So aside from interest rates, the amount of capital for down payments will play a part in the pricing of commercial property, which are really the cap rates, what we're talking about. So particularly in recent years has been a great example. The pandemic, trillions of dollars has been printed, and there's been a lot of capital out there which has been assigned or allocated towards multifamily and commercial real estate. So with that influx of money, there's been an inflation in the prices of multifamily property. Remember, an inflation of prices going up mean that cap rates generally coming down. So the amount of capital out there willing and able to invest in commercial real estate causes the prices and the prices to go up and the cap rates to come down. So it's not just debt, but it's also the capital, the upfront capital required for it.